everyone. Today we are going to study the topic working capital under Introduction to Corporate Finance. Working capital. Working capital is the capital required to carry out the day-to-day business activities. It ensures smooth working of the organization. It requires capital to purchase raw materials, semi-finished goods, or even finished goods if it is a trading organization. This investment can be on cash basis or credit basis. Funds are required to purchase adequate raw materials. The excess of current assets over current liabilities is known as working capital. Working capital is the money available to fund a company's day-to-day operations, essentially what you have to work with. It is the difference between current assets and current liabilities. Current assets is the money you have in the bank as well as any assets you can quickly convert it into cash if it is needed. Current liabilities are the debts that you will be repaid within a year. So, working capital is what's left when you subtract current liabilities from current assets that you have in the bank. Here in this chart, that is the working capital cycle, we can observe that when there is cash, raw materials or inputs are purchased. With those raw materials, the finished products are manufactured. When the sale takes place of those finished products, it again gets converted into cash. This cash is along with the profit. Keeping apart the profit, we now again have the cash that is used to purchase the raw materials. According to Jestenberg, circulating capital or the working capital cycle, it means the current assets of a company that are changed in the ordinary course of business from one form to another. For example, from cash to inventories, inventories to receivables, and receivables again to cash.
Working capital is a measure of a company's financial strength. Pete is thinking about investing in the automotive industry, and he has his eye on two companies, Arthur's Engines and Joe's Motors. Pete calculates the working capital for each company. Arthur's Engines has $200,000 in current liabilities, liabilities that the company must pay this year, and $320,000 in current assets, assets that can be converted into cash in less than a year. Pete subtracts current liabilities from current assets for both companies and discovers that Arthur's has $120,000 in working capital. This means the company can easily pay down its short-term liabilities or debts using its current assets. This is a sign of a profitable and efficient business. Joe's Motors, on the other hand, has $400,000 in current liabilities and only $360,000 in current assets, meaning the company has a working capital of negative $40,000. Negative working capital suggests that Joe's may have trouble paying its short-term debts. Joe's might be forced to sell an asset or raise more capital through long-term debt like a bond. Or in the worst case, the company could go bankrupt because it can't pay what it owes. Because of Joe's Motors' negative working capital, Pete chooses Arthur's Engines as an investment. Working capital helps investors judge a company's financial health and future prospects. But no single measure tells the whole story. Working capital is one of many metrics investors use to evaluate a stock.
A constant flow of working capital is an important component of a successful business. In this example, we can observe that there are current assets and current liabilities. When we have assets and the current liabilities, we have the working capital which is in the form of cash or short-term loans or the inventory, and we have the operating expenses. So what are the sources of these working capital? Sources of working capital can include mainly trade credit such as the sundry creditors, bills payable and notes payable. Short-term sources are tax provisions, dividend provisions, bank overdraft, cash credit, trade deposits, public deposits, bills, discounting, short-term loans, intercorporate loans, and commercial paper. These sources depends upon the terms of such credit, maximum credit limit, period of credit, and discount on cash payment. Therefore, a business firm arranges capital for maintaining an adequate stock of raw materials, for maintaining sufficient funds to pay the short-term loans, and for covering day-to-day operating expenses. Let us now understand the factors affecting working capital requirements. Nature of business. If the firm manufactures goods that are sold on a regular basis, like essentials, then less investments in working capital is required. There would be regular cash flow. But if the goods are costly and less in demand, investment in working capital would be more. This capital can be acquired on cash or credit basis. The requirement of working capital depends on the nature of business. The nature of business is usually of two types: manufacturing business and trading business. In the case of manufacturing business, it takes a lot of time in converting raw materials into finished goods. Therefore, capital remains invested for a long time in raw materials, semi-finished goods, and the stocking of the finished goods. Consequently, more working capital is required. But on the contrary, in case of trading business, the goods are sold immediately after purchasing, or sometimes the sale is affected even before the purchases itself. Therefore, very little working capital is required. Moreover, in case of service business, the working capital is almost nil since there is nothing to stock. The next one, that is size of business. The working capital requirements depends upon the size of the business. Bigger the size of the business, more will be the requirement of capital. Working capital requirements is directly influenced by the size of the business. The firm operating at large scale need to maintain more inventories, debtors, etc. They generally require large working capital, whereas firms operating at small scale require less working capital. Greater the size, larger will be the requirement of working capital. In some cases, even small concern may need more working capital due to the high overhead charges, inefficient use of available resources, and other economic disadvantages of the small size. Volume of sale. The sale of the organization decides the amount of working capital requirements. More the sales, more will be the requirement of working capital. Working capital requirements, the volume of sales, and the size of the working capital are directly related to each other. If the volume of sales increases, the company requires more amount of working capital and vice versa. Production cycle. The process of conversion of raw materials to finished products is known as production cycle. Working capital is required in more quantity when the process is long. The process of converting raw materials into finished goods is called production cycle. The amount of working capital directly depends upon the length of operation cycle. Operating cycle refers to the time period involved in production. It starts right from acquisition of raw materials and ends till the payment is received after sales. The working capital is very important for the smooth flow of the operating cycle. If the operating cycle is long, more working capital is required. Whereas for companies having short working capital, the working capital requirement is comparatively less. Business cycle. The economic situation in a country decides the requirement of working capital. When a country faces inflation, essentials are required. A firm manufacturing essential goods requires more capital in such a situation. The need for the working capital is affected by various stages of the business cycle. During the boom period, the demand of a product increases and sales also increases. Therefore, more working capital is needed. On the contrary, during the period of depression, the demand declines and it affects both the production and the sales of goods. Therefore, in such a situation, less working capital is required. Terms of purchase and sales. If a firm purchases its raw materials on cash and sells the finished goods on credit, it requires more investment in working capital. But if a firm purchases raw materials on credit and sells on cash basis, then investment is less in working capital. If credit terms of purchase are favorable and terms of sales are less liberal, then requirement of cash will be less. Thus, working capital requirements will be reduced. A firm gets more time for payment to suppliers. A firm which enjoys more credit facilities needs less working capital. Credit control. Credit policy refers to terms of purchase and sales given, the time period given for recovery of money, and similarly the time taken to pay its creditors decides the requirement of working capital. The enterprises which sells goods on cash payment basis need little working capital, but those who provide credit facilities to the customers need more working capital. If raw materials and other inputs are easily available on credit, less working capital is then needed. On the contrary, if these things are not available on credit, then to make cash payment quickly, large amount of working capital will be required. Growth and expansion. Working capital is decided on the basis of growth and expansion that takes place in the organization. If the company decides to expand, then it will invest more in working capital. Growth means the development of the scale of business operations, that is production, sales, etc. The organizations which have sufficient possibilities of growth require more working capital, while the case is different in respect of companies with less growth prospects. Management ability. If there is proper coordination in the management, planning invest in working capital will be managed efficiently. The requirements of working capital will reduce if there is a proper coordination between the production and distribution of goods. External factors. Banks and financial organizations play a very important role in providing finance as and when it is required. Firms use these loans as an investment in working capital. If a firm is able to get loans from these institutions conveniently, then it takes the help of these institutions regularly. Companies that are able to access banks for financing or to raise funds through the issue of debt or equity capital will be more likely to have a healthy rate of liquidity to keep their operating running smoothly. When interest rates are high, it becomes expensive to borrow funds. Taking a short-term loan for improving the working capital situation would be more viable. So above were the factors that affect the working capital requirements in any organization.